Hello and welcome to the Integrity Financial Insights podcast. I'm Debbie Packer, Founding Financial Adviser at Integrity365, and today I'm delighted to be joined by LGT Vestra's Ben Palmer, who is a Senior Portfolio Manager and responsible for the Sustainable Service offering. Together, we will be discussing key market themes across sustainable investments, especially in light of the shifting political landscape in the US. The US election cycle is a major topic of discussion, and its outcomes are expected to have significant implications for energy transition and the future of sustainable investing.
Firstly, thank you for having us on today, Debbie. I know we're going to be talking about Trump and the US more specifically in a bit more detail, but just to give the general overview first, then we came out of 2024 with the portfolios providing some pretty good positive returns. It was a market in 2024 that it was challenging to keep up with some of the headline indices, so global markets more broadly, because we were in a period where they were dominated by a very few number of large US technology firms, which we have some small exposures to a couple of those companies. But given the sheer impact of their performance on the overall market, it was slightly more challenging to keep up with those returns. But nonetheless, we do believe the portfolios provided some good, strong, robust, positive returns. As we led into the start of this year, it's actually been a really encouraging start to 2025 for the portfolios. The main reason being that we've seen what we would call a broadening out of the market. As I already mentioned, last year, a lot of the returns were generated by a very small segment of the US market. We've seen the start of this year actually with market leadership coming from areas like Europe, where the portfolios have larger exposures to and have generally performed pretty well. And in line with this, those large companies in the US have actually started to come under a bit of pressure this year. So some of your listeners may have heard about this new Chinese company, DeepSeek, an artificial intelligence company, which has really sent some shockwaves through the US AI scene. And has called into question the dominance of companies like NVIDIA that has performed so strongly in 2024. And we've seen their share price retreat a bit. And that's been, I suppose, a benefit to our portfolios because we don't hold much exposure to those types of companies. So generally speaking, it's been a pretty positive start to the year with all the portfolios in some pretty strong positive territory and also pleasingly at the moment outperforming benchmarks.
Oh, thanks, Ben. Now, of course, we've heard a lot about the impact that Trump will have. So since the US elections, we know that he's now back in power and he's implementing a lot of key actions that he's talked about. And obviously, people are a little bit nervous about how sustainable markets will react to his leadership. One of those actions was the withdrawal of the Paris Agreement.
Yeah, and absolutely. This was in the lead up to the election. We were spending quite a bit of time thinking about potential outcomes and what Trump 2.0, as his second term is being called, would mean for our portfolios and the investment opportunities that we have. And as you say, that the centerpiece for this, for our portfolios and the market, has been around energy transition. What's Trump going to do to things like the Inflation Reduction Act, which is the US package that Biden brought in of around just under $400 billion worth of support for scaling up their renewables in the US. Leading into the election, post-election, and now actually into his presidency, our thoughts remain relatively consistent in as much as important to say, if you had the choice from a sustainable perspective, Trump wouldn't necessarily be the president you would select. But we do believe that some of the media narrative and some of the market narrative as well maybe overstates the impact that he'll be able to have on this specific area. And I'll try and give a couple of reasons why that is. So firstly, we've seen Trump before. So obviously he had his first presidency between 2016 and 2020. And he came in with a very similar playbook from an energy perspective. He withdrew them from the Paris Agreement back then. And he also made some big rhetorical commitments to coal and turning away from renewables. And actually what we saw in his first term is that renewables continue to expand at pace. They went from the fourth largest generator of electricity to the second. And we saw the steady decline of coal continue to fall off and other fossil fuels. What were the reasons for this? Well, firstly, in the States, there is a big division of power between the White House and the states. And what we saw in his first presidency is that a lot of those states that hold a lot of the purse strings for these types of initiatives continue to invest in the renewable space. And we've already seen some of the states start to make those sorts of tones as well. In terms of the Inflation Reduction Act, so this big package of policies, then most of the benefits of that so far are going to Republican states. So around 85% of the Inflation Reduction Act is benefiting Republican managed states. So politically, again, it's a little bit more challenging for Trump to just rip the rug from underneath his core base. For example, Texas, which obviously historically has been the home of fossil fuel production in the States, is now the capital of renewables. And in terms of the investment they're getting over the next few years, it's more than the next 5 states combined. So there's some very interesting political underlying currents at play there. And then the probably most important thing for us is the economics. So when you look at fossil fuels, Trump's big message is drill, baby, drill. That's his rallying cry around the energy picture for the US. Now, when you actually look at does drill, baby, drill make sense, then the economics don't really stack up currently. Reason being, Trump wants to drill, baby, drill because he wants to bring the oil price down, because that will help inflation, it will help growth, and importantly, it gives that feel-good factor to the electorate. If it's cheaper to buy energy, cheaper to fill up your truck, then people generally feel pretty positive about the economy and about the president. And he's spoken about oil prices around $50. Now, the current oil price is around $70. The important factor here is that the oil companies have said, in order for us to meaningfully drill and increase the amount of oil we're exploring, then we need about $85 a barrel. So there's this big gap between where the oil price is, where Trump wants to move it, and what the oil companies want. They're moving in opposite directions. So what we think is likely to happen, and we've seen this to date, and actually a company like Exxon, a very large the largest US oil company, have said that they're unlikely to actually expand their exploration because it doesn't make economic sense for them. So what we're likely to see is probably a bit of the status quo as we currently see. And then if you offset that with the fact that wind and solar, onshore wind and solar, are the cheapest form of new electricity generation. So in a power-hungry US economy, where energy demand growth, so the amount of energy they're going to be using is going to be increasing over the next few years, the cheapest and most economical way of them meeting that is through renewables. So we think that ultimately will keep the trend moving in the right direction, and mean that, as I say, whilst Trump isn't the perfect president for the sustainable agenda, we think the investment opportunities will still be pretty resilient second term.
Excellent. So the economy behind all of those facts is perhaps stronger than the leader of the country is the key takeaway on that. Within sustainable investments, Ben, we've seen a lot of volatility. You touched upon this earlier, particularly sort of 2022, 2023. Can you expand on why that was the case?
Yes, absolutely. So 2022 was the most challenging year for the sustainable proposition from a performance perspective. Really, when we look into the detail of it, it was the first few months of 2022 which were the most materially negative period of time. And the reason being is that it was in that window when we saw a very quick change in what the market expectation was for inflation and therefore interest rates. So that was the period of time, actually, if we go back a bit further to 2021, where we had increasing inflation coming into the UK economy, European and US economy. But the belief was that this will just pass through without much pain. And it was just a factor of that COVID period that we were going to have a little spike in inflation and then it will come back down naturally. In that first couple of months of 2022, it changed quite considerably to the view and the reality that inflation is going to be here for a while and we're going to have to move interest rates up quite significantly to try and actively bring it down. And that change in understanding and sentiment in the market meant that we saw a lot of different types of investments sell off, so reduce in value quite quickly, because how they are ultimately valued is based partially on interest rates and inflation. So that's sort of a key component of what investors are looking at. And from a sustainable investment perspective, we held more investments in the areas that were impacted more by that than probably a more traditional run portfolio. The second thing that went against us in that window is that it was the time when we saw the Russia invasion of Ukraine. And two assets that did particularly well in that period were defense companies and more traditional energy companies, because we saw increasing oil and gas prices. So we entered a bit of a perfect storm for a period of time where we owned more of what was negatively impacted through the inflation and interest rate story, and we didn't gain any protection from the defense and the energy bounce that we saw given the Russia-Ukraine war situation. So that was really what drove that poor period of performance through 2022. And then as we came into 2023, really a lot of the investments we were exposed to went through what we sort of define as a wait and see period, because this is when we just saw interest rates being increased in the economy. So not month on month, but pretty consistently for a period of about a year, the US, Europe, and the UK were increasing their interest rates. And the market just kind of, as I say, just sat there and waited to see when it was going to stop. So we didn't necessarily lose a lot of ground in that period, but portfolios generally track sideways. What we saw at the end of 2023, when the last interest rate was delivered, is that the portfolios started to structurally move upwards again. And that's the journey we've been on for about 15 to 16 months or so. And you'll see in the return profiles that we've been on a much more sort of positive structural increase since the last quarter of 2023.
Yeah, and Ben, that is noticeable when we're doing reviews with clients and we're looking at the portfolios. It is a measured increase. So, throughout 2024 and the start of this year as well, the performance certainly has had quite a seismic shift. So, what do you see the future trend for the sustainable sector going forward this year?
So I think for us, we believe we are quite a differentiated proposition or a portfolio of investments compared to a lot of the more traditional portfolios that you'll have. So what that gives you is that diversification benefit. And in a market, as I say, where over the last couple of years, it's been what we define as quite narrow, as I say, so what that means is, a small number of companies driving returns has been, as I say, more of a challenge for us to keep up with. But what we have started to see towards the end of last year and into this year is that trend is shifting. And we're seeing the returns broaden out through the market into areas where we have more exposure. And we do think that should continue to be a benefit through the course of this year. We also think that areas which have been less loved by the market over the last year or so, in areas like healthcare, which is obviously quite an important area for these portfolios, have again this year started to, their outlooks have been improving and the market has been rewarding them for that. We've already touched on the energy transition piece, which again is another fundamental theme for our portfolios. And whilst we've seen some shorter term sentiment swings in markets with share prices around Trump, actually the underlying revenue, so how these companies are performing, has remained robust. And for the reasons I mentioned earlier, we think that Trump's impact will be a lot more moderated. So we see, based on where the valuations of those companies are today, certainly continuing opportunities in that space. So sort of generally speaking, we feel quite positive for this year ahead. I mean, it's very clear we're going to have to deal with uncertainties, largely coming from Trump, but we live in a world where we're going to have to make sure that we keep abreast of the constant movements of the geopolitics. But we gain a lot of comfort that our portfolios, we believe, are attractively valued in terms of the value of those companies today, what they're delivering in terms of making money, the revenues they're generating, and the fact that they are underpinned by these longer term structural trends, which we think are still very important around cleaner economies and healthier societies.
Yeah, absolutely. I mean, as a member of the investment committee within Integrity365, we're really committed to blending client investment portfolios. We don't make the call on is active better than passive, because we know that different economic cycles each will hold its own for different reasons. And we are very considered when we look at including sustainable investments within that blending. So a lot of our clients do have, typically 20-25% of their portfolios within that space. So it's hugely important. But as you mentioned, Ben, it is that diversifier. It is doing something a little bit different to the other funds in there. That's why we blend them. What benefit do you feel this provides our investing clients? So to have, 20-25% in a sustainable portfolio alongside general funds, what benefit do you feel that offers to them?
Yeah, I think it's a really important point, and I think um, we are quite differentiated. So there's a few things that I'd highlight on that point. So you mentioned passive investing there, Debbie, which gives you broad market exposure. Generally, those types of investments have performed pretty well over the last couple of years because you have more exposure to those larger companies, which is, say, have really been driving markets. We do think we blend quite well with that approach because we are a fully active solution. So what that means is that all the underlying funds we invest in have active management, which tends to result in smaller portfolios. So we are generally exposed to between 400 and 500 underlying companies. So it's it's a more concentrated solution in that respect, whilst it's still diversified across geographies and sectors. But we think it complements a passive approach well, because as we have seen some of those larger businesses start to weaken, and maybe the passive investments have caught more of that negative downside more recently, we have probably been able to counterbalance that with our proposition. Just like last year when those markets were performing extremely strongly, we provided counterbalance in both ways. So diversifying, I think, with our proposition provides that benefit. And then just the secondary thing I would say is that we do believe that there's a very strong line through the portfolio holdings in our proposition around their sustainability characteristics. And for us, we do think that over a longer term window should be beneficial overall for portfolios. So it leads us into certain areas of the market where we see those structural growth drivers. So you'll tend to have more exposure to areas like healthcare, like industrials, some of these areas of the market, say, which necessarily haven't kept up with those large cap technology companies that we've spoken about, but are now beginning to find their feet in the market and provide that upside that we hope to continue through the course of this year.
Excellent. And again, you mentioned about having holdings across 400 to 500 companies. That's a really significant exposure. How do you see sustainable investment management influencing how companies behave? Because I'd imagine that's quite an important part of your role and the investment manager's role.
Yeah, absolutely. It's hugely important. What we view our role as is, obviously investing clients' money on their behalf. And firstly, we want to be investing in good quality businesses with really strong, sustainable strategies in place. But we're also very aware that no company is perfect and that there are always areas of a business model that can continue to improve. So we take what we call the stewardship responsibilities very seriously. And what stewardship relates to is how do we engage through our fund managers with those companies to emphasize areas where they can continue to improve, and where we are ultimately owning the shares of those companies and you have voting rights at company meetings, making sure that those votes are being placed in the right way to drive businesses to improve. And we have a 3-strong stewardship team based here in London who sit alongside us. We work with them very closely and collaboratively with the underlying fund managers in the portfolio to ensure that we're seeing that evidence through the portfolios. And it's a really important lever of change within our economy that investors do use their rights and responsibilities as investors within companies to ensure that there is continuing progress.
Excellent. No, I think that's a really powerful message as well. It's, not just sustainable investing, but it's the ethics and the management behind it as well. So no, thank you for sharing that. I know when we spoke a few weeks ago, Ben, you mentioned quite a powerful point, and it's going back to the Trump and the US, maybe on the climate change side. But I think the little fun fact that you shared was that every 3 weeks, currently the US experiences an extreme weather event, which costs more than $1 billion worth of damage to be repaired. And that compares to events happening every 4 months just 40 years ago. I think that's, quite seismic. That's quite a shift. And, just going back to sort of the whole Trump and the economics, they can't ignore that, can they, as a country?
And I think from an investment perspective, this is something really drives our thinking in terms of why do we think investing in these themes is the right thing to do, but also of longer term benefit for the investors in those companies, because there's real economic consequences that we're feeling at the moment, and that's a good stat that you have there, Debbie. The rise in extreme weather events, you can't help but turn on the news, and there's something going on in the world which is devastating from an environmental perspective and a social perspective, but also economically. When these hurricanes rip through, or the wildfires we saw more recently in LA, it displaces people, it shuts down local economies, people can't get to work, factories burn down, and it has a financial cost. So we feel that although the policy ebbs and flows, that generally speaking, governments want strong, resilient economies. That's how they get re-elected. And that's why we'll see, generally speaking, a broad-based support. And companies that are helping address these areas, we think have got good growth pathways as we move forwards.
Yeah, no, I think it's fascinating, and as I say, being on the investment committee and being able to speak to investment specialists such as yourself, Ben, I think it's nice that we're able to share the information that we have as a business with a wider audience and with our clients, because I think that information it's interesting and it brings portfolios to life, and it sort of shares why having that diversified approach and that blended approach to investments is important. So no, I really appreciate that. My top takeaways from our discussions today, Ben, is all around, maybe the leadership of the US isn't the only thing to think about when it comes to the economics within America. Everything going on in the world, diversification is still key. And also taking those stewardship responsibilities within the sustainable markets is also really important as well. So no, I really appreciate your time. Thank you so much, Ben, for joining me today. I'm sure all of our listeners have found it as insightful as I have. So thank you.
Pleasure. Thanks for having me on, Debbie.
You're very welcome. I'd also like to thank everybody on the podcast for listening. Please don't forget you can catch up with all of our previous podcast episodes on YouTube and Spotify. So if you'd like to speak to one of our independent financial advisors about your own investment opportunities, please not hesitate to get in touch. All of our details can be found in the episode description or on our website at integrity365.co.uk.